Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks & Associates Wealth Management. Today is Wednesday, August 3rd, 2022, and this is our monthly market monologue. But before we dive into this month's review of the stock market and some of the economic indicators, I just want to take a special moment and say thanks to two teams. One is the team that I've been blessed to build here over the years. I've got a great team, and I'm just so thankful that I have such a team that I can step out like I did the last 10 days or so to participate in another team. So recently I had the opportunity to join a team called Team Jazzed, and they invited me, a friend of mine invited me to join Team Jazzed to participate in an event called RAGBRAI. RAGBRAI is the oldest and largest ride of its kind, where effectively it is an 8-day bicycle ride across the state of Iowa. You start on the western coast by dipping your rear tire in the Missouri River, and 8 days later you finish by dipping your front tire in the Mississippi River, which is the eastern coast of Iowa. And it was a great event. We camp each evening, usually in somebody's yard. And one of our hosts told us that their town had a population of about 1,600 people. But as a RAGBRAI volunteer, she was told that RAGBRAI brings in between 30 and 33,000 visitors in a single day. Think about that. A town of 1,600 swells to more than 33,000 in a single day. So it's a really big event for some of these small Iowa towns. As a result of all these people coming into town each day, a lot of churches and small organizations, dance troops, Boy Scouts, etc., they hold fundraisers to feed all of the riders and support crew as we ride through town. And this is where I learned that strawberry rhubarb pie is far more popular in Iowa than here in North Carolina. And strawberry rhubarb is my all-time favorite. I think on the 8-day ride, I had at least 8. I think I had 8 pieces of pie, and 6 of them were strawberry rhubarb pie, my all-time favorite. So again, thanks to my team. It was an absolutely gorgeous ride. Thoroughly enjoyed it, and I'm so grateful to have the team here back in North Carolina that allows me to do something like that without clients missing a beat at all. So with all that said, let's go ahead and dive in and take a look at what we see in the stock market and take a look at the S&P 500 for the month of July. You can see that the month of July was a pretty good month in the S&P 500, where it recovered about a 9%, effectively erasing the losses for the month of June. And you can see that overall the market fell about, or the S&P 500 fell about 25%. And so the question naturally is, with a big rally like we saw in July, is the bear market over? Let's take a quick look at the NASDAQ. That's what's on the screen now. And again, a very good month for the tech-heavy NASDAQ index. Again, pretty much erasing the losses that we experienced in June. NASDAQ rising about 12% on the month. Again, NASDAQ, we have to remember that we have seen approximately top to bottom about a 35% drop in that index. And so again, the question that many are asking is the bear market over? And so again, with a 13% rise in the NASDAQ, it certainly suggests that it might be, but we have to question whether or not this is a bear market rally. So that said, one of the things that we're going to talk about is the concept of correlation. So to talk about the concept of correlation, I've got on the screen right now the S&P 500, which is the green line, and the Dow Jones Industrial Average, which is the red line. And what I'm trying to do is highlight what this concept of correlation means, because you can see that both of the red and the green line, they kind of rise and fall together. So their correlation is very, very high. I'm wearing a suit. My jacket and my pants are perfectly positively correlated. It's the same color, it's the same fabric, it is the same. That's perfectly positively correlated. On the screen, the S&P 500 and the Dow Jones Industrial Average, they are very highly correlated. They're not perfectly correlated because you can see some differences. There's a gap here between these two lines. That means they're not perfectly correlated. So whenever we see the market rallying like it did last month, sometimes we'll get questions from clients to say, hey, the market rallied strong last month. Why didn't my portfolio? And it's this concept of correlation. So what do I mean by that? The reality is we want high correlation when the markets are going up, but nobody wants high correlation when the markets are going down. And so that defines a large part of why we do things the way that we do things, because clients in general, especially our clients who the majority are in approaching the later stages of their working career, and so they feel like they can't tolerate big market downturns like we saw in the year 2000 and the year 2008. And then this current correction. Most of our clients do not want to participate in that downside correction, but naturally we all want to participate in the upside movement. And so when we are talking about managing a portfolio for a client, we want to be highly correlated in the up markets, but we don't want to be correlated to the stock market when the markets are going down. Well, that's not going to be a perfect correlation. And so what is on the screen right now is the S&P 500, but this time the candles, and this is a monthly candle chart, and this time the candles are color-coded to coincide with our VSI signals. Remember, the VSI is 14 individual technical indicators that I'm kind of rolling up into one composite indicator to give me a weight of the evidence approach of how we want to be allocated, whether we want to be really aggressive or we want to be very defensive. And so what you see over here is in 2022, we actually got some warning signs twice in 2021. I guess this is flipping into 2021 here. And you can see the candles changed into black and red. That is when it's on a warning sign and when it's definitely on a composite sell signal. Well, there's no such thing as a perfect technical indicator that is going to help us get out at the top and get in at the bottom. That's not realistic, and that is not what we are trying to do. So what we are trying to do is take the weight of the evidence approach and say, what's going on? Is this a upward trending market or is this a downward trending market, and react accordingly. So in the month of July, again, we see this white candles are good. The full body candles where it's colored in like this one, that is a bad sign. That's where the market was very negative in June, but in July it was very positive, just about erasing the losses from the prior month. And so again, the question is the bear market over? Stay tuned. We're going to talk more about that. But again, when we have this big rally, clients will sometimes ask, hey, why didn't my portfolio rally as strongly? And sometimes we might even see losses in a portfolio in a situation like this. Again, that is because our strategies are not correlated to the overall market, and they're not correlated intentionally because clients want to participate in the upside but do not want to participate in the downside. And so we are waiting for the weight of the evidence to try to progressively pull us back into the to the markets. And so sometimes we will miss a short-term rally. So yes, the market rallied in the month of July, but the reality is that the weight of the evidence is still suggesting caution. As of the end of the month of July, 5 of 7 of my short-term signals were pointing to a buy. Only 1 of the 7 long-term signals were pointing to a buy. So the weight of the evidence says 6 out of 14. That is still the minority. 6 out of 14 of my signals are suggesting a buy. So that is still suggestive of a caution, and that's what we're doing. We are waiting for the weight of the evidence to pull us in. Now, that doesn't mean we wait completely. We do have some pilot positions that have been put on, but we put them on in small measures because the weight of the evidence suggests caution. So I've used the term bear market rally a couple of times. Let's talk about what that means, because this is exactly why caution is warranted. So on the screen right now is, again, the S&P 500. I've marked it up to highlight a couple of things. This is January. This is when Russia invades Ukraine. You can see the overall trend of the market is falling. So in particular, I want to talk about this period right here. This is the month of May, the second half of the month of May, and we get this rally. This is a bear market rally. Okay, the market is coming off strong. You can see this is a nice candle right here. This is a bit of indecision. And then we have 1, 2, 3 very strong days. The market is rallying. That is a bear market rally. And the only reason we know that is because it failed. So we don't know, is this on the right-hand side, what happened in July? We won't know if this is a bear market rally until whether or not this rally is confirmed or if it fails. So again, this rally here in late May turned out to be a bear market rally simply because it failed. So we can't know definitively what's going to happen in the month of August. If the month of August sees negative pressure again in the stock and the markets go back down, then we know July was likely a bear market rally. And in a bear market, these rallies are very, very dangerous because they can pull you in. And so this is why we take a cautious approach, because we don't want to get overly aggressive, because we are not trying to pick the bottoms, because there is some evidence to suggest here in May, hey, this is the bottom, let's hop back in, and nope, we found a new bottom. Okay, and so that is what a bear market rally is. And so again, we're being pulled in, and we are using what we refer to as progressive exposure. We have a couple of pilot positions in because we might very well have seen, this might very well have been the bottom. So we don't want to sit on the sidelines forever, but we're going to wait to be pulled in slowly as the evidence suggests that it is appropriate to do. So let's switch and talk a little bit about the overall sectors. This is, again, the 11 sectors of the S&P 500, and I've highlighted June 7th. This top, what is that, maroon? This maroon line here is the energy sector. And in particular, what I'm trying to highlight, one of the things I've been saying all year long is the energy sector is the only sector in the S&P 500 that has been positive. And that's where our sector rotation strategy was invested. But in June, we started to see a major correction. Somewhere along the lines, we got stopped out of our positions in energy because, again, we don't know, is this a correction or is energy just catching up to the bear market that the rest of the market has experienced? So we got stopped out of those positions. And here we got the month of July, and you can see that energy drifted a little lower in the month of July, but has since rallied strong. Again, still the only sector that has had a really good year, just had a really tough 45-day period of time there. We do have two sectors that are positive. One is energy, and then the other one is utilities. Remember, utilities is a defensive sector, so the fact that that's positive doesn't say really good things. However, let's switch gears and talk about some good signs. Again, I'm going to show you Apple and I'm going to show you Amazon. I'm not recommending Apple and Amazon. So if you're watching this and you're not a client of ours, don't take this as a recommendation by any stretch of the imagination. But I'm showing them because Apple and Amazon in particular, and these are only two, there are others that have the same influence, but Apple and Amazon have an outsized influence on how the overall broad indexes perform, because those broad indexes, the S&P 500 and the NASDAQ, they are cap weighted, which means the biggest stocks in those indexes, Apple, is going to have an outsized influence over how the overall index performs because of the way the math actually works under the hood. But what I want to show you is the fact that Apple has recovered pretty nicely. Again, here's this rally. It looks like a bear market rally. Apple fails. It falls to new lows. It rallies again, could have been a bear market rally, puts in a higher low, and then has had a really good month of July. That is a good sign, because if Apple does well, that's going to move that index up. But that's also something we have to be careful of. And I'm going to show you in a second. But what we have to be careful of is the question that we have to ask is, Apple and Amazon and Microsoft and Tesla, all these really big stocks, are they doing well and that's why the index is moving up? Or are all of the stocks, or the majority of the stocks in the index, are they doing well and that's why the indexes are moving up? But the fact that Apple has had a really good month of July is a really good sign. Now here's Amazon, again, not a recommendation. And so again, what we see is a little bit of a bear market rally. It completely failed. A little bit of a rally, failed again. And then this is last Friday, the last day of the month, showing that Amazon gapped up and it was up about 10% in a single day on very heavy volume. That's what this line is down here. These are the amount of shares that are bought and sold. So again, that is a very good sign. Again, those are just some good signs that I want to show you, and I'll show you one more. On the screen right now is on the top we have the advanced decline line, and on the bottom is the S&P 500. So again, the S&P 500 is the 500 largest stocks in the United States as measured by Standard & Poor's. Now, I'll just remind you of what the advanced decline line is. This is the New York Stock Exchange. So it's a little bit different than the S&P 500. So this is all of the stocks that are in the New York Stock Exchange, and it's the advancing stocks minus the declining stocks. So I want to point your attention on the left-hand side. I've got this green line drawn on the top of the S&P 500 to show you that from November into the end of the year, the S&P 500 overall continued to go up. But you could see this is something we talked about back in December. We saw the advanced decline line actually starting to go down. That is a warning. That again is talking about the Amazons and the Apples of the world. Those really big stocks are moving this average up, but the majority of the stocks are actually going down. That's what we refer to as a negative divergence. This is a warning sign. Now, let's look on the right side of the screen, and we see the opposite. On the right side of the screen, we see again the S&P 500 is moving up, but look at the advanced decline line. The advanced decline line is also moving up. That is really good news, and that's given us some encouragement that the stock market might very well have put in a bottom and might very well indeed be recovering. So just because we have a very strong month of July, that doesn't give us the all clear. We have to look for the weight of the evidence, and this again is the advanced decline line is one of the things that we're going to take a look at to determine, or to contribute to that weight of the evidence. Now let's switch and talk about a couple of economic data points, and then we'll wrap up for the day. So one of the things we've been talking about for the better part of the year is whether or not we are in a recession or whether or not we're going to see a recession. At the end of the first quarter, we told you that the official statistic was that the U.S. economy declined by 1.6%, so that is negative GDP. Well, now the second quarter of this year came in at negative 0.9. So historically, the textbooks would tell us that a recession is when we have 2 consecutive quarters of negative GDP. Folks, we now have 2 consecutive quarters of negative GDP. They're there. However, I've also seen some evidence to suggest that the latest definition of a recession is when we see significant GDP contraction. So this in 2020 is significant GDP contraction. That's clearly a recession. And so there is going to be some debate by the people that actually declare that whether or not we're in a recession. The National Bureau of Economic Research, they're the ones who effectively declare whether or not we are or are not in a recession. Remember, they declare this retroactively. So they're not going to make a news announcement in the next couple of days to say we are or are not in a recession. That's not likely going to happen. But what we would take a look at is we're saying that we have 2 consecutive quarters of negative GDP. So by a lot of definitions, that is indeed a recession. The question is whether or not we're recovering or not. And that's going to bring us to the next point. The next point that I want to talk about is the Fed funds rate. On the screen right now is the Fed funds rate, the effective federal funds rate, dating back all the way into the 1950s. Again, we've talked about this all year, and the fact that for the last 40 years we've been in an overall declining interest rate environment, and these interest rates are going to have to start rising, and that's what's happened. You can see that the Federal Reserve and the Federal Reserve Open Market Committee has been very aggressive in raising the interest rates, putting the effective rate right now at about 2.3%. You see I've drawn on here the number 3, a demarc line of 3. We have not had an effective federal funds rate of 3% since, 2008 maybe, I think was when that is. But 3% is what the Federal Reserve is talking about. Like, they expect to get us to 3% by the end of the year. Now, the important thing is when we go back and we look at the GDP numbers, we have 2 consecutive quarters of negative GDP. So there is some talk that the Federal Reserve is going to slow down how quickly they're raising interest rates simply because they don't want to induce a recession. Now, again, I would contend we're already in a recession. Therefore, the Federal Reserve doesn't want to make the recession even worse. And so that is the battle that they're facing. There's some encouraging comments lately from some of the members on the Federal Reserve Board that they do not plan on reducing the speed at which they're trying to get us back into a quote-unquote a normal environment. The fear that some of us in the industry have is that they're going to put a pause, they're going to slow down the rate of change on their federal funds rate because of the fear of making a recession worse. The challenge is inflation is the bigger problem here. And I don't have that on the screen. We've talked about that for a number of times over the course of the last 6 months or longer. And the best tool that the Federal Reserve has is by raising the interest rates. So I'm certainly hoping that the Federal Reserve continues to raise rates. I do think they need to do it gradually, and they have been, but I think they need to continue raising rates to dampen inflation and then try to get inflation out of the economy, because the longer it takes them to get that under control, the worse it's going to be. That very well may mean that we are in a recession for a longer period of time. So that remains to be seen. So overall, I would say there's some good news. The market had a very good month of July. We do have some progressive exposure. We are being pulled back into some of our positions. That's good news, but we are very cautious that this very well could be a bear market rally. So we are being very careful in that regards. Obviously, if you have any questions, by all means, feel free to reach out to me or my team. We are more than happy to answer any questions you may have. You do not need to be a client in order to ask us a question. Again, I ask that you please like this video and make sure you've subscribed to our YouTube channel. We do post multiple videos throughout the month. Our monthly market monologue is usually the longest and most widely watched, but we do post other videos throughout the month. So if you've subscribed, you'll get a better chance of actually seeing those videos. So again, thank you for watching, and it's an honor to continue to serve you, and we hope you have a great month, great last few days or last few weeks of summer, and we look forward to talking to you again soon.